Welcome to the Women's Growth Series. And we have the pleasure, I should say, of having Cara from REMN here. And Cara, why don't you introduce yourself and tell us a little bit about REMN?
Okay, Cara DeStefano. I am the Regional Sales Manager for the Southeast region of REMN. We are a wholesale lender really committed to the broker channel, and I have been with the company for over 11 years. Most of our people are very tenured here as well. So, we're very excited to be able to represent AIME and the Women's Mortgage Network here today. Thank you.
Well, we are so happy to have you here on the show. And of course, we are thrilled to be bringing you an educational video today regarding investment properties. We really try here with the Women's Growth Series to bring some type of educational product knowledge from time to time. And we really are thrilled to be able to have you on the show today to go over all of the parameters of investment properties. Yay! So I guess I should introduce myself for those who don't know me. My name is Melinda Payan. I'm the owner of The Truth About Lending. I have been a broker owner for over 25 years. I started when I was 4, so just kidding. We are really a company that preaches education, making sure that our loan officers really understand guidelines and how important it is to really know your guidelines to be successful in this profession. And Cara is one of our partners. REMN is one of our wholesale partners who we absolutely love. I can tell you that we've had fantastic experiences with her, with the company. You really feel like you're really dealing with real people. You speak to humans all the time. So thank you very much, Cara, and your team for all that you do for us. Absolutely.
Right, absolutely, because your team does an incredible job, and it really is a partnership with us. And,
well, thank you.
So.
Well, today we're going to start by really just delving into the guidelines about investment properties and, how do you work with them? What are the requirements? What are you looking at from seasoning requirements, down payment, loan to values, all of these things. And we're just going to go over a series of different questions so that everybody can just really break down to the basics of what do you do with an investment property, because there's so much business out there for all of us to really obtain. And as the rules change throughout the industry, we always have so much more of a leg up on the retail side because we do have so many more options than banks. And part of that is really knowing when something can fit into, the different guidelines and how to really maneuver the guidelines. So let's start off a little bit by talking about seasoning and what are the requirements for an investor who holds title to a property, and how long before they hold title can they do a cash out? And let's talk a little bit about that.
Sure. So when we're talking about seasoning on investment properties, first of all, we're going to be talking about two different pieces on investment properties. We're going to be talking about your conventional side, your Fannie Freddie guidelines, but we're also going to be talking about non-QM. Really because, let's put it out there, you and I were discussing it, the elephant in the room, which is recently occurred with Fannie Mae. Fannie Mae did announce that as of April 7th, they were only going to take 7% of their portfolios from a lender secured by second homes and non-owner occupieds. That being said, many of the lenders obviously drove up their pricing. So right now, today, it's a little challenging to do non-owner occupieds from Fannie, but let's discuss it anyway because it may very well change in the near future on it. We're all going to hope for that. So relative to seasoning, and we talked a lot about this, Melinda. The biggest growth in the banking industry always is, wealth through real estate. And one of the biggest areas that people have done this is in the non-owner occupied segment. We saw it back in the early 2000s. That's where people were acquiring properties. We saw a lot of properties acquired again when the market, with the housing crisis. 2010, 2011, we brought a lot of people back into the market, being able to acquire properties for low prices and use them for rental properties. We're seeing that again because now we are in such a demand for real estate. When demand for real estate comes in, a lot of investors obviously want to get onto the bandwagon with it.
Right.
So a lot of these properties that people purchased in the 2000s and early 2000s, 2010, in that time frame, were done by cash. So there's a ton of equity in these people's properties that they're trying to tap into. So your question regarding, seasoning on it to tap out of it, whether it's Fannie Mae or non-owner occupied, in most cases, it is going to be a minimum of 6 months before they get cash out on it. However, if they acquire the property through divorce or if they inherited the property, they can cash out sooner than that because that's treated different than property acquisition for a person.
Got it. And I'm not sure if you can share a little bit about the guidelines with Fannie Mae in reference to if it's owned in an LLC and the individual is 100% owner, what the guidelines are pertaining to that.
Sure. So if it is owned in an LLC with Fannie Mae or Freddie Mac, they can refinance it, but they have to take it out of the LLC.
Right.
Many investors like to put their properties in individual LLCs to protect their interests. Now, non-owner occupied properties, non-owner occupied non-QM properties typically can get financed in an LLC. We offer that at REMN under our products, and most investors do offer that as well, to do properties in an LLC.
So, Cara, it's my understanding, and please correct me if I'm wrong, because I certainly can be wrong in this industry. You never know. Yes, we have to check and double check and triple check, and then maybe the rules have changed in between the first time and the last time. One of the things that I have recently experienced or that I found out is that if somebody purchases a property in an LLC and they're 100% owner and they're the only ones that are going to be on title, they can actually quit claim it at closing, and the 6 months start from the time that the LLC purchased it. Is that correct?
You're correct. That's 100% correct on that.
All right, guys. So for all
agency, and again, that's for agency. Right.
So everybody who's listening out there, make sure you just heard what Cara said, that if somebody purchased a property in an LLC 6 months ago, that the seasoning starts the time that they purchased the property, if in fact they're now going to quit claim it at closing, I assume, or right before closing, one of the two. And at that point, they would have to be 100% owner, or all the owners of the LLC would need to be on the new loan, something to that effect.
Correct. 100% correct.
Okay. And so you touched base a little bit on non-QM and some of the stuff that REMN offers. Can you discuss a little bit about the differences and what are the options that REMN offers?
Sure. At REMN, we offer on the non-QM product for non-owner occupied a variety of products. We do have the full doc product, which is obviously a big alternative now with Fannie and Freddie kind of pulling out of this. We do have 1-year income docs, light docs, if you wanted to do something like that. But the biggest one, the number one product and I would say probably industry-wide on the non-QM, is the investor cash flow, or a DSCR. And basically what that is, you're not verifying the employment or the income for the individual, but really it's a pity wash. Is the property able to carry the payment? And that's really, it's a very simple process. It moves very quickly because of that, because you really don't need to verify any kind of job, any kind of income, anything of that nature. And usually it's a 1-for-1 ratio. So the pity basically has to carry, the rents have to carry the pity. There are cases with lower loan to values. If it doesn't quite pity wash out in that respect, you can do that as well. But that's the number one type of product that is available on the non-QM that most people lean to. Because again, it's not about rate on those type of products. Again, when you're dealing with a savvy investor, it's about cash flow. And that's really what it comes down to there.
Absolutely. And even the debt service coverage ratio rates, when I look at them, to be honest with you, those are the rates that were the Fannie Mae rates when I started in the 90s. So I'm thinking to myself, you're not verifying anything, and you have the option as an investor to keep the deed of the property, I believe, in the LLC, right? You're able to keep it in the LLC.
You can do it in the LLC and keep it in the LLC, which is a huge option there as well. So you don't have to go through retitling and closing.
So for those who have not yet,
My dog in the background.
that's okay, don't worry.
He's screaming and he's making little
No worries. For those who have not done a debt service coverage ratio loan, to simplify it, when Cara is talking about the one-to-one, literally what they're doing when they do the appraisal is a rental income analysis, right, Cara?
Correct.
So they're going to use what the appraiser determines as the fair market rent. I'm assuming even if there's a lease on a property, they're still going to use, unless the lease is actually for less, they're going to probably use still the fair market rental analysis.
Normally they'll use the fair market rental analysis. There are certain circumstances where you may be able to bring in the lease. Maybe the property is rented below market currently because it's rented to a family member. In those certain cases, you can possibly bring in a lease as well.
But it's my understanding that you don't technically need a lease. Is that right? Or
don't technically need a lease on this. Most investors will not require to see the lease because it's already established within the operating income statement.
All right. So for everybody who's listening to this, this means if you have somebody who has an investment property that's owned free and clear in an LLC and is one of the borrowers out there that doesn't want to provide anything, you can do a cash out refinance on this, right? Cara? You can do a rate and term refinance. You could do a purchase. You could really assist your investor clientele to leverage their properties. So you could actually do a cash out refinance and then use those funds as secured borrowed funds to enable them to be able to purchase a property, right, Cara, to do another DSCR loan.
Correct. And the cool thing too that you can do is, again, because a lot of these investors are sitting on free and clear property. So you're 100% correct. You can go ahead and cash out on that property that they own. And now they can come in as a cash buyer to another non-owner occupied. But here's the cool thing that you can do. There are options called delayed financing. So basically, if a buyer wants to come in and try to offer a lower market price and close quickly on something without financing, they can go up to 6 months later and refinance now and get the cash back out that they put in as a refinance. They just have to show that it was their funds to get in there. It can't be borrowed funds. It can't be a gift. As long as they put their own equity in there, if they refinance their cash out or whatever, they can do that as well. So now here again, I'm always about leveraging opportunities just like an investor would. You now have, two possibilities of doing the loan. You're doing the cash out on the property that they own free and clear.
Right.
They can go in and buy cash, and now you can do the delayed financing and get a new loan for him on the new property that he purchased.
So I have a question for you on this particular product, just because it is so popular right now. I think I know the answer to this, but I'm just going to ask you, are gift funds allowed on this program?
Yes. I can't speak for other people's guidelines, but our simple access product at REMN, yes, we do allow gifts on it. We do allow up to 100% gifts on it.
Wow.
They reduce the LTVs by 10%, but we do allow 100% gift. So again, if there's a gift of equity situation, maybe a family member is giving the property as a gift. They can do it that way and reduce the LTVs. Now that is not allowable on Fannie Mae. Fannie Mae does not allow any gifts whatsoever. None for down payment, none for reserves. But the DSCR products do allow them. Or our DSCR product does allow it. Like I said, I can't speak for everyone out there, but ours does allow a gift.
So I can speak as to the other lenders out there. And many of them don't allow a gift on the DSCR program. It has to be the funds of the borrower, has to be seasoned, or at least the funds. Some have no seasoning requirements, but it has to be the fund. So the bottom line is that that's really wonderful that REMN is offering that, especially since when you look at the Fannie Mae product, no gift funds are allowed on investment properties ever. There's a lot of loan officers out there that don't realize that. And not until they're deep into the transaction is it a oh crap moment where they should have asked the borrower in the beginning. So if you're listening to this and you're looking at a Fannie Mae, a paper conventional kind of investment property loan, remember gift funds are not allowed. And this is a great alternative. Cara and REMN is a great alternative to having access to both. And one of the things that we personally love about REMN is that you have that a paper conventional side with all of the really great rates and wonderful programs. But if you have a situation where you then have to be like, oh crap, this isn't going to work, it actually can be transferred to this other program without creating, at least that's my understanding, right?
Yeah, sure. Yeah, without creating a whole new package and a whole new submission, new appraisal.
Dealing with appraisal and
exactly.
Can you talk a little bit about mixed use properties and what the perspective is of REMN on that and what you see?
Well, if you look at agency product as well as our non-QM, it follows the guidelines with regards to mixed use. So mixed use, they have to occupy the residency piece of it as well as the commercial piece of it. So in those, and it is only for one unit dwellings. So one unit with the storefront or whatever it may be. So you really don't have an opportunity to do that under owner occupied. But if you do have somebody that's looking for that, mixed use is available through the agency as an owner occupied, and again, it's also available through the simple access product, the non-QM, if they want to do like a bank statement program or a 1-year 1040 or something like that, they can do that. Yeah.
So I'm going to ask you a question that I think a lot of us really need clarification on, because you've got the COVID overlays and the COVID overlays are gone. Then there's no overlays. Now there's a different overlay. When somebody is purchasing an investment property, and let's just say that it's a conventional Fannie Mae loan, a regular normal loan, and there is not a lease yet, or maybe there is a lease, at what point can we count the fair market rental income for that property? Do they have to have a lease? Is it allowed to not have a lease? Can you just kind of fill us in where we are in the overlay land?
Yeah, so again, it just goes into the operating income statement piece of it. The appraiser will provide the operating income statement in the rental analysis. So if there is not, if the unit is vacant, they can use the rental income and the projected rental income on it. The only thing to keep in mind is if it is a first-time landlord, you cannot use the rental income to qualify. That goes for Fannie Mae, that goes for just about any product. So if it's their first time dabbling in this, they have to, they can't use the rental income to qualify with regards to that.
They need a lease at that point. They have to have it rented out.
Yeah, they definitely do.
Okay, got it. So what happens if an investor had a property for sale? Are they allowed to do a refinance or even a cash out refinance if it was recently for sale?
Sure. That's again something that's interesting. Somebody might have put the property on market and said, oh no, you know what? Maybe I won't sell it. Maybe I'll just keep the property and again leverage it and take cash out. You can do that one day off the market. They do need to have a good reason and an explanation for it, but they can get the cash out one day off the market.
And there is also a lot of people who originally purchased a house as a VA loan or an FHA loan, and then they may have been transferred or they moved. Are they allowed to then convert that to a rental property and do a refinance, or how does that work?
Sure. So a lot of times that's what happens. People will purchase a home as a first-time home buyer, FHA, move out of the property. Maybe it was a multifamily or, a single family, moved out and got a conventional loan on something else. And yes, what they can do, a lot of people don't realize it, is that you can do an FHA Streamline as well as a VA IRRRL if the property is currently non-owner occupied. So at one point it had to be owner occupied in order for them to get that financing. But you can go VA to VA on the non-owner occupied FHA Streamline. So again, great alternatives for people that they may not be looking at that. I always recommend when they're talking to the customer, talk about the other properties that they do own, ask them what kind of financing. You may have opportunities to get, again, more loans and help the borrower a little bit more on that as well, lower the interest rate.
Well, this is one of the reasons why we love you, because you're so great with your guidelines, because, I've been doing this for forever and a day. And I didn't even realize that you can do that if they have left the property. So
Yeah.
it's really impossible to know every single guideline, but with an amazing account executive like yourself, we're able to really learn all of these things. I have a question for you in reference to short-term rentals. So I'm in South Florida, and I know you are as well, I believe, right? And I know we have people watching from all over the country, and I think this is a very common problem. We've got these short-term rental income properties that are getting way more rental income on an annual basis than what the fair market rental analysis will actually yield, especially for us, the properties along the coast or waterfront or whatever the case may be.
I have a property in the Keys, and I do VRBO rentals.
So how is that looked at from Fannie versus the non-QM world? Can you kind of give us some info on both sides?
So Fannie will not allow the short-term rental income. The non-QM products will, at least our non-QM product will allow them to look at the short-term rental income on that. So those are options as well in that type of situation.
So on the Fannie side of things, let's just say we have somebody who's doing a rate and term refinance and they've owned the property for a while and they've got rental income reported on their Schedule E. And let's say the rental income is, I don't know, $50,000 a year, but the fair market rental analysis comes back that the rental income should be $20,000 a year. Can we at least use the $20,000, being that they have a history of showing the rental income of something that's higher than that, or how is that really looked at?
Repeat that question.
Sure. So yeah, that's okay. So we have borrowers who are making significant rental income on their investment properties that are doing the VRBO.
Okay, gotcha.
And it's much higher income than what the actual fair market rent is.
Gotcha. Okay.
Can we at least use, as long as it's reported and we have the history of it on their tax returns, could we at least use the lower of the two, so the fair market?
We can. That's why I thought you were. I thought you were saying the VRBO piece. I wasn't sure. Yes, you can still go ahead and use the fair market value rent to qualify.
Got it. Got it. And so, you know, one of the questions that we often get is, if somebody inherits a property and it is going to be an investment property, how is that viewed?
You can certainly, as I mentioned, if they've inherited the property, they can cash out of the property with the less than 6 months seasoning on it. They certainly, if they're buying it from the estate, we have that type of situation as well. Again, it just gets into the question of whether you are a first-time landlord, if you've been a landlord before, or if you have not been a landlord before. So that really is what it comes down to. If they've purchased the property, they have a history of being a landlord, you can use the rental income to qualify. If it is a first-time landlord, they really, and they don't own a primary residence, then you are in a situation where they kind of have to carry the property itself. If they are a first time, I think I said something and I want to back up on here. If they are a first time landlord, they can use, I got to double check my notes on this, because they can use the rental income, but they can't put it into positive cash flow. Just bear with me 1 second on here.
Yeah, I think there's some kind of overlay that it changes.
I got it. Yeah, first time landlord, they cannot use the rental income on a one family. This is where I was getting confused on it.
Okay.
They cannot use the rental income on a one family. If they get into multifamilies, they can use the rental income out of two. If it's a 2 unit, they can use rental income from 1. If it's a 3 unit, they can use rental income from 2, and a 4 unit, they can use rental income from 3. But a single family first time landlord, they cannot use the rental income to qualify.
Got it. And I would encourage everybody who's listening, if you have something that's a primary residence that they're buying a multifamily, like 2, 3, 4 units, to speak to Cara and make sure how that applies on the primary side, because the guidelines are very different on different products.
Correct.
So Cara, we really appreciate you being on the call today. Can you tell us a little bit about why you have supported the Women's Mortgage Network?
I am so proud of this group of ladies. You know, I've been doing this. I've been in lending for 33 years, and never at any other time have I seen such a more dynamic time from women in the mortgage banking industry. You know, it's a lot different than when I started, and I was going to tell a story, and I don't know if I should tell the story or not about when I started.
Come on.
Okay.
We have to hear it.
So I was first time on the road. I had been in business for 2 years processing. First time on the road, I was a loan officer, 24 years old, and I walked into an office of realtors. No slighting to realtors, but I went in, and they were pompous, they were misogynistic, and they told me they only do business with men, and that if I wanted their business, I basically had to get naked on their desk.
Wow.
Yeah, well, you know, I had 2 words for them, and it wasn't Family University. But I wasn't going to let that deter me. That was the first sales call I made. And for me, my determination was the hell with them. I'm just going to do something bigger and better. And, you know, somebody's going to see that I have talent here, that I know what I'm talking about. I know how to structure loans. So it went, you know, we are just in a completely different time. You know, I feel very empowered by the women that I meet on the Women's Mortgage Network. You know, you and I have been doing this a long time. We have so many new, young, energetic people in the industry. And I think the one thing is that, you know, we learn from each other, we lift each other. There's a real sisterhood with this group.
There really is.
Yeah, I am so proud of everybody for what they're doing and how they're empowered and how they support each other. Nobody feels like any question is stupid.
Right.
They ask the question and you get really positive feedback from this group. So we have to keep bringing all our sisters in the group here, you know.
Absolutely.
Well, you know, there's power in numbers here. So
absolutely. We have a fantastic group of many amazing professional women, and we are continuing to grow, and we hope that it just continues to double and triple from there. And we really appreciate your time today. And I do want to say something to all of the members that are listening. Keep in mind that my real belief is there has never been a better time to be a broker ever. When interest rates start going up, that's the absolutely best time to be a broker. Why? Because we have so many options. When people are sitting on the sidelines going, oh gosh, what can I do now? This person doesn't qualify. We have the DSCR loan. We have the light doc loan. We have all of these options to be able to offer our clients really a menu of mortgage options out there. So just keep that in mind, everybody. Keep grinding out and have a wonderful day. And thank you so much for joining us for this episode. Thank you, Cara.
Power up, ladies.